Now, the title of Understanding Alpha, let me first say that what I will not be able to tell you is how to get alphas, at least not in this lecture. But what I hope to do by having you look at and understanding the sources of alpha, as I'll define them, that you may be able to improve performance in the management of your business of asset management, whether you're on the buy side or your advice provider. And that's the purpose of doing it, understanding sources and how it might help you in performing the activities for which you do for a living. So in this, they're all over the place, you can see them. So in that, let me just say the agenda for today is precisely to tell you about what the different sources are. I want to tell you about my approach to investing in a practice sense. It isn't theoretically perfectly, but it really is a lot easier, I think, to understand and manage. And that is, I think of the investment process, if you like, and I can just move up to this slide, which is my picture of the whole investment process, soup to nuts, beginning to end. And I think the investment process breaking down is between, you can really think two activities. One is getting the best performing risk engine you know how, okay? In other words, if it were a car, the one with the highest horsepower, the best one you know how to construct. And what do we mean by best or most powerful? Well, I'll use Sharpe ratio, the highest Sharpe ratio you can achieve. Now, the CAPM, the capitalized pricing model, is 50 years old since its publication. And a lot has happened in practice of finance in those 50 years. But as we saw from the discussion this morning, it's still Sharpe ratios. And as long as we define alphas in terms of betas, we're using covariances. In effect, we say an alpha means we can get a higher Sharpe ratio. So I'm going to stipulate, at least for my talk, that even today in 2016, in general, what we're paid for, right or wrong, is for ultimately allowing people to get higher Sharpe ratios. That's part of it, but a very important part. So when I say the best performing engine, I mean create the portfolio which has the largest Sharpe ratio you know how to do by any source, okay? Without regard to what you're going to use it for. Again, if it were literally an engine, build the best engine, and you use the same engine whether you're going to race at Le Mans or whether you're going to use it in the back 40 with a hoe pulling out the tree roots. You gear it differently and everything, but why wouldn't you want to have the most powerful engine, no matter what the task? Then you use other sources. The parallel in investing is, and I can show it here, is first you build the best engine for risk, and that group. Then, depending on the goal or why you have the portfolio in the first place, what are you trying to achieve? Someone mentioned retirement. There's a very good example where that's goal-based investing, right? The idea is to try to fund your pension liabilities. The goal is that. So then you manage the portfolio with that goal in mind. If you have a different goal, you're going to manage the portfolio differently. What I say is the way you express those different goals in terms of the investment process is not how you mix the risky portfolio. You don't change the mix of the risky portfolio in my world. What you do is you dynamically mix that best risky engine, best risk portfolio. Since it's Sharpe ratio, you might as well call it by what you all know, the optimal combination of risky assets. You take that engine and you mix it with the risk-free asset dynamically through time to optimize getting to the goal. And that's why you end up with different results if your goal is, say, a pension liability versus something else. Okay? So the way you express goals, the expressive specificity of the portfolio comes from that dynamic measuring. I'm saying all this simply to frame what I'm talking about, which is I'm going to focus on the optimal combination of risky alpha. But I want to say I think that's very, very important, and I think it works pretty well, but I'll leave you with make your own judgments about that. I will say on goal-based investing, by the way, I think one of the big trends in investing is going to be goals-based investing, where you actually focus on a goal, define a goal for the particular portfolios, and then optimize to that goal. Now, you all say, well, aren't every portfolio run with goals? The answer is no. But if I start talking about that, we won't get to my topic. So if you like that, if that teases you at all, then you can have me come back next year and I'll tell you the rest of the story. So if you look here, this is the super efficient maximum Sharpe ratio optimal combination of risky assets. There's the risk-free asset. By the way, the risk-free asset is very goal-dependent. Clearly, the risk-free asset for a pension fund is a very long-dated bond, which has great price volatility, but income stability. If the goal is income, then the risk-free asset for a pension plan is going to be a very long-dated bond with high price volatility, low income volatility. If, on the other hand, you have a wealth goal, then the risk-free asset is something like a treasury bill or something else, very little price volatility, effectively none, but income volatility all over the place. So the risk-free asset, unlike the optimal combination of risky assets, will be very sensitive to the goal, and you need to do that. But you find the right risk-free asset, you mix it with the best risk engine, you dynamically mix them through time till you end up, you may even alter the shape of the portfolio to fit the goal, and you can do that in a variety of ways. Today, I'm focused on just the optimal combination of risky assets part of that. And in that context, we're talking about the sources of alpha. Now, I'm going to go through this. There was some question about what do you mean by alpha or beta. I'm going to be very precise in this. I'm going to say, start with the capital asset pricing model. If that held, or held good enough, what's the optimal combination of risky assets? It's the market portfolio. It's a cap-weighted portfolio. You're done. And if that were the case, if the CAPM held, this would be a very short talk. But we know it doesn't hold as an empirical matter, and there are reasons why. And if it doesn't hold, then you have the following result. Then there are alphas, which means you can improve the Sharpe ratio over holding a cap-weighted index portfolio. Okay? So alpha exists. The question is, where is it, and how do we find it? So I'm going to suggest that there are three types of sources of alpha, what I'll call traditional alpha, financial and services alpha, and dimensional alpha. And let me start, first of all, the reasons that the CAPM may fail. Well, first of all, if you didn't know it, 40 years ago, Fama and Black, Jensen, and Scholes rejected the CAPM. The security market line was too flat at any level, and that's been going on for 40 years. Now, those of you who went to business school and were taught the CAPM, you can't ask for a refund on your tuition for being taught something that we knew 40 years ago was not good enough, because it's not a wrong model. And this is important to understand. It's not wrong, it's just not accurate enough. And there's a difference. All models are approximation. The question is it good enough an approximation? And the answer is the CAPM is not a good enough approximation. But it's not wrong. It gives you the right intuitions. If you want to know what I mean, how many of you remember what the ratio of a circle is to its diameter? Come on. Pi, right? What's a model of pi? 3.14. What's a less incomplete model of pi? 3.14159. Now, for some purposes, 3.14 is good enough. For others, it's not. That's the way I think you should think of the CAPM. It gives you the right intuitions. It just isn't good enough for your purposes. So it's not a wrong model, so you can't ask for your tuition back. Okay? So now if we take that alpha does exist, the question is, where does it come? I would guess if we went down the street and randomly stopped people, or at least went into the city and stopped people randomly and said, where does alpha come from? What's the source of alpha? I would bet, for those who even know what you're talking about, that they would say, oh, that's market informational inefficiency. That's a lot of syllables. What does that mean? It comes from that they're faster, quicker, smarter investors and dumber, slower, and cognitively dysfunctional investors. And the faster, quicker, smarter make alphas at the expense of the slower and dysfunctional ones. It's essentially a zero-sum game. It's actually a negative-sum game because you spend resources doing it. But it's basically my win is your loss. I call that traditional alpha because that's, I think, where most people say it. They may say it a little differently than I do, but they come to that conclusion. And this may well be the case. If you have that kind of alpha, that source of alpha, how is that strategy at alpha that comes from that source, how is that traded? How do you execute the strategy? Well, if you're an information trader, what's your biggest fear other than your information is wrong? Your fear is you won't get the trade that you want on before the information becomes available, because we all know important information doesn't stay silent long or unreflected. So what happens when you come to trade? You come to trade, you want to get the trade on as fast as you can. And so, you know, if you're all professionals, if someone said to you, I'm going to make an alpha, I've got information, and I want to trade with you, and you're on the other side, I think most of you would say, I don't want to trade with you. Yeah, there's maybe some kids from the schoolyard want to say, I know you think you're smarter than I am, I'm smarter than you, let's do it. Professional investors, for the most part, don't want to trade with people who think they have information. That's a tough business, okay? So I think most times you just walk away if someone said that. Of course, if you're a market maker, you don't have a choice of walking away, because otherwise you wouldn't be a market maker. So you're going to see that. So somebody comes in and says to you, I'd like to buy 100,000 Intel. And I'm the market maker, and I look through my book, electronic book, but you know, I'm old-fashioned. And I say, gee, I don't have any Intel. How about AMD? Yeah. Nope, got to be Intel. And oh, by the way, the trade has to be done by 1 o'clock. Sounds like that person thinks they have information, right? They got to get a very specific trade done quickly. What will I do as the market maker? Well, in some conditions I might walk away, but if I keep walking away, I won't have a job. What am I going to do? The first thing I'm going to say to you is, I'll do not 100, but I'll do 20, so you constrain the quantity. What's the next thing I do at this, or at the same time? I pull the spread out to protect myself. So what do you know if your sources of alpha are information-type trades, market informational efficiency? You know that's an expensive strategy, meaning you're going to pay up in terms of transaction costs for immediacy and specificity. Does that mean it's bad? No, it's just a high-cost strategy. What else do you know? It's not scalable. I can't do 10 million Intel, okay? So I wanted, in parallel with each of the sources, identify the source, and then also talk about the trading characteristics, because that's going to be important to understand as well. Okay, so that's the source of alpha. My question, do you have any other sources of alpha? If we don't have market information inefficiency, can you have alpha? Well, we can do it. I can't tell you in the real world, who knows, but I can do an experiment. I can use a model, and we can test that within a model. What if I have in the model that all the agents trading in the model know the means, variances, and covariances, they agree on them, and they're the correct ones in the model? Then, of course, in the model, there's no market inefficiency, is there? Informational inefficiency. Can such a model produce an alpha? The answer is yes. Let me give you an example. Suppose, consider a Japanese commercial bank, large Japanese commercial bank, and it's decided to go long the yen, along the interest rates, along the curve. Not a very unusual transaction for them. But how do they take that position? They can take it in JGBs in the cash market. How else could they do it? Futures, how else can they do it? Swaps, right? There are a variety of different ways they can execute exactly the same risk exposure. Now, suppose they look at what do all Japanese commercial banks, all commercial banks have? They have a capital requirement, regulatory capital requirement. And I believe, you know, some people argue that it's not a cost, but ask any of the banks here in the city if they mind you raising their capital requirement, and you'll see they don't like it. So they at least believe they have a cost. So if the regulatory capital has a cost, then if taking the same exposure in different ways gives you different capital hits, then you're interested in that. Now, just for argument's sake, so we can make it just as an example, suppose you look at taking the exposure just either in swaps or cash, and it turned out when you do the capital rules, swaps have a lower capital requirement under the rules than cash. And this isn't about capital requirements, you understand? It's just saying it's something that distinguishes. If that's true, then what would you advise the bank, or if you worked in the bank, what would you tell them how they should execute? Well, if they could save from capital costs, then they're better off using swaps versus cash. And Jen, just for a number, I don't have a computer up here, forgive me, you know. Let's say that they see 20 basis points. I had to do calculations in my head, so I'm using round numbers. A 20 basis point saving in capital charges. So by doing it in swaps, they save 20 basis points to get the same exposure they would in cash. Now, if one Japanese bank is doing that trade, what's likely to be true? Nothing to do with hurting, but doing the fact that they're in the same business. A lot of other ones want to do the same trade, and they have the same capital requirements, so they're all going to come to the conclusion that they ought to express that in the swaps. What's the issue now? Execution. How do they do that? As you know, in the swap market, the futures market, or any such market, it takes two sides to a trade. Who's the other side of the trade with all these banks? Who does the other side? It can't be another bank, because if another bank does it, they're going to suffer the same capital costs. So a bank can't help a bank. Can anyone give me a suggestion of existing financial institution might be a likely low-cost counterparty, meaning a natural provider, other than someone who happens to just want to be short swaps? Nobody? Come on.
Insurance companies.
Well, insurance company's not a bank, but they have a lot of regulation too. I would suggest to you a hedge fund. And what do I mean by a hedge fund? What defines a hedge fund? They do everything. A hedge fund is a lightly regulated institution. If I'm going to be the counterparty to banks and insurance companies who have regulations that affect which ways they do it matters, okay, then the best provider of that would be a lowly regulated entity. Why? Because if they're regulated, they're going to run into the same problem. So hedge funds, and this is a view I've had for many years, some of you may not know, but I was a co-founder of a fairly large hedge fund over 20 years ago. That hedge funds, I think, a good source of their excess returns come from this kind of thing, but I'll come back to that. So hedge fund. What would be a second one? Depending on the audience, I actually get the second one sometimes first. Sovereign wealth fund. They're government, but they're very low regulated. They don't pay taxes. They don't have capital requirements. So sovereign wealth fund would be my substitute for hedge funds. But that's the kind of entity. I want you to see this as institutional. There's a function to hedge funds. They don't just sprout up because they make money for investors. They sprout up because they perform some kind of role in our financial system, just like the frogs in a pond do something for the ecology. And hedge funds, among other things, provide that role in this system, in my view. Okay? So let's say it's a hedge fund. It's the best counterparty we can find for the banks. You can find others, but it's going to be more expensive. Why? Because the hedge fund doesn't care whether it does swaps or cash or anything. It's slightly regulated, usually tax neutral, doesn't care about any of that sort of stuff. Okay, well, you all learned in school or know from your business the formula that would relate the price of swaps to the cash market, the no arbitrage number, right? Because they're the same risk, they have to have a fixed related price. What if we quoted that price in the market for these banks? The banks would take it. Who would provide it? Would the hedge fund? No. Why wouldn't the hedge fund do it at the no arbitrage price? Because it doesn't make any money from it. And it's got to pay its workers, it's got to pay its capital, it's got expenses. It's got to make a profit like every other business. So that's not going to be the equilibrium price. What's going to happen is that swaps are going to have to be a bit rich. They're going to have a lower yield, higher price than they would theoretically, in order to provide the sufficient compensation to induce the other side to supply all those banks with the swaps. So where's the market equilibrium for that? Well, we know it's not zero to the theoretical value. It's got to be some positive amount. What's the upper bound? 20 basis points, because beyond 20 basis points, the banks get no advantage. So we know equilibrium is somewhere between 0 and 20. I can't tell you where it will be. Sometimes it'll be 4, it might be 16. That's markets. But there'll be an equilibrium price. Let's just say it's 10. You know, I'm trying to make it simple calculation for me, okay? Suppose it's 10 basis points. So you call out a price of 10 basis points rich for swaps. The banks look at it and say, well, if I don't do the trade, it's going to cost me 20. I'm giving up 20. I'm paying 10. I'm going to make 10. The hedge fund sees that it's going to make 10 basis points of pure alpha. And it is an alpha. They're getting compensated for, as you would measure it. So unlike the information trade, when I go to the marketplace and say, I'm going to make 10 basis points to you and I'm an information trader, you run away, the banks say, great, we got a deal. Why? Because both parties gained. And sometimes in our profession, we're so caught up in, who's faster, quicker, smarter, we forget that the principal reason for trade is both parties benefit from it. It's not a zero-sum game. It's not a big casino. We're not spending trillions of dollars and having all this thing unvoted to that. So the point being is that in this equilibrium, you're going to have both parties better off. But you look at that hedge fund, and as I just said, you will measure it as an alpha. Why? Because unlike standard intermediations, where I sit across the table in a bank and they charge me a fee, the hedge fund makes its profits by the spread it earns from the mispricing, so-called mispricing. And you will measure that. In the same way, if you were measuring a market maker, which is another service, right? The market maker makes a spread, you would measure that as an alpha. It looks like they're creating alphas. Now, this is a true alpha for you as an investor. If it's net of fees, you're still getting it. But it's a very different alpha than the first one. Notice it has nothing to do with information. It has nothing to do with any party being stupid. And by the way, it works in a world where everybody has the same information. The banks understand they're paying 10 basis points more. My God, if they don't have somebody in their shop that could work out the swap, the zero arbitrage condition, they're in a lot of trouble. They know they're paying 10 basis points up, but it's still worth it to them, okay? So I've just established for you there's a second source of alpha, which has nothing to do with information trading, but which is financial services. And indeed, I think it's a growing area because as we globalize the financial system, it's good news, I think that's a good thing, at least that's my judgment. What we do is we get greater and greater effects of all of the unintended consequences of all the regulations, taxes, accounting. That now, because we have kind of one market for the world, at least a good part of it's right, the effects of changes in the EU on regulations or here have effects in Singapore and other parts of Asia and vice versa. You just get more and more of these different things like capital requirements having unintended consequences of cost or creating differentials which require financial services. So I actually think this is a growth area, and it's a competitive one. Okay? So I call that kind of thing financial service alpha, not information-based at all. What about trading in that? Well, because I know it's a financial service trade, I know why these Japanese banks are doing it. They're not doing it because suddenly the government's going to suddenly call all the premium Japanese bonds and they want to get out of the cash market. That's an information trade. But they're doing it because I understand they're doing it for purposes of reducing their costs, in this case, capital costs. If it's not an information trade, I'm willing to do the other side of that trade, much bigger size than I do an information trade. I'll do 100,000 of that instead of 20 because it's not an information trade. I know why it's going on. And if you look at, by the way, if you go to any of the hedge fund shops, even the big quant shops, the head person who's typically a founder or something, what does that person spend most of their day doing? Designing models for the fund? No, they have people that do that. Evaluating, identifying trades? They already see the 10 basis points there. If they don't see that, they shouldn't be in business. What they're doing is calling around everybody they know in ministries to find out why the 10 basis points is there. Why is it mispriced? Because if they don't know why, then you better be suspicious it's an information trade, then you want to be very careful about doing that trade. If you could convince yourself that the why of it is it's something like this, it's not an information trade, you can do it in much larger scale. So that's really important to the success of the fund. The same would be true for prop desks if there are any left. Okay? So that's a very different activity is what I want you to see. And the scaling is different. You can do much bigger scale in that kind of an alpha than you can in information alpha. Okay? All right. Suppose, are there any other alphas? We now have two. Can you think of any other alphas? Well, again, I can't tell you in the real world, but I can tell you using a model. The first step in the model to get you to show you the second alpha was to put in everybody knew the means variances and covariance to get rid of information inefficiency, and I showed you an alpha can still exist there. Now what I'm going to do is make the assumption that there are no capital requirements, no transaction costs, that you can trade 24/7 frictionlessly, that all these frictions out there are gone. Scalability, everything. What's that called? That's called a perfect market. So we have an informationally efficient market. Now we have both an informationally efficient and perfect market. You can't do any better than a perfect market in terms of market design. In an informationally efficient and perfect market, can you have alpha? Okay, the answer is yes. Now, I asked you a few questions, and with all respect, maybe it's your respect for me, I didn't get many answers. So you know what professors do in their class when they don't get anyone putting their hand up? They do what's called a cold call. And that's when they call on someone who doesn't have their hand up. So I'm going to exercise my professorial right and find some, you guys can listen in and help her out. She won't need help, I'm sure. You ready? Yeah. Are you sure? Okay, well, no, come on, listen carefully. Which would you rather have? 5 million pounds or 10 million pounds? 10. How many agree with her? Anybody who doesn't, see me after the talk. I will be glad to give you 5 of anything in return for 10 of the same thing back. Okay, so that wasn't too hard, was it? And we got agreement. And this is a professional crowd. And by the way, one that doesn't seem to be unusually irrationally exuberant or anything. So you're a good test group. You did so well. I have another question, just to follow up. A little more complicated, but just listen. Which would you rather have? 5 million pounds, and for the rest of your life or your institution's life, okay, the only investment you have is a real gilt at a 10% interest rate. Inflation-protected gilt, 10% interest rate. There's no choice. That's it. So 5 million pounds and 10% gilt interest rate, or 10 million pounds and the only investment you have is a real gilt with a 1% interest rate.
I go for the 5.
5 and 10. How many would agree with her? How many would take the 5? How many would take the 10? You're too young. Think about it. By the way, I'm not surprised. You know one of the reasons I picked on you, besides you making the mistake you sit up front. I knew that the answer, almost surely she would give, was that. Now let's analyze what she just answered, and all of you, or most all of you, agreed to. You just gave up 5 million pounds, right? She could have had 10 or 5. The first time, everybody picked 10, right? And most of you switched from 10 to take 5, right? What did you just demonstrate? Because there was another variable, another parameter that changed in the experiment. This is my fastest way to point out to you that in the CAPM, which is a one-period model, remember, its abstraction from complex realities is one period. You have investment now, and you have the end of the period, and you're done. That's all you care about. It's a one-period model. If I had asked you the question and said, over the next year, you can have 5 million at 10% or 10 million at 1, which would you have picked? You would have picked the 10, right? Yes. Of course. That's why I put my hand up. Not that I'm feeling morbid, but you know, the fates have a way of punishing the sins of hubris. But I was quite sure you would break it around. In fact, you could see that it depends how long your horizon is going to be. Real horizon, not trading horizon, but all that matters to you. If it's 1 year, you take the 10. If it's how many years would you for sure take the 5? Well, you can work that out. How many people know the rule of 72? Oh, computers have gotten you. What are you going to do when all the batteries fail? Yes, you do. Okay. Well, there's one. For users who don't know it, now you've picked up something, you can use it, you know, lunch or something, is if you want a rough estimate of how long it takes to double your money at a given interest rate, you divide the interest rate into 72. So at 12%, your money will double in about 6 years. At 8%, in about 9 years. okay? I don't have a calculator here, so I figured I'd use that. So how long would it take before the 5 million at 10% dominates the 10 million at 1%? Well, the difference is 9%, right? A 9% difference in growth rate. You divide 9 into 72, you get 8. So in 8 years, approximately, the 5 million at 10 will pass the 10 million at 1. And then forever after, it's earning 10 while the other one's earning only 1. It just blows it away, right? So as long as your horizon is over 8 years, or your institution's horizon is over 8 years, you should probably pick the 5 choice. But the purpose of all of this was to say there are other variables that are important to investing, first order important, than end-of-period wealth, which is what the CAPM assumes in all its derivation. The other important is because we're not here for one period. We're in here for many periods. And what is one of the risks that I don't think, if anyone can forecast it well, then please see me afterwards and I'll be happy to sign up with you if you can prove it. How many, is that you picked because it's a better investment opportunity set. The 10% interest rate was such a great investment environment compared to 1, you were willing to pay half your money to get a better environment. Now, unfortunately, we can't know what the future environment's going to be. It's uncertain. But you see, that's a risk. We'd much rather that next year it's 10% versus 1, if we're investors, not borrowers, all right? But 1, we don't control that, and 2, we can't forecast that or forecast it well. Therefore, it's a risk that next year the opportunity set may be poor or it may be good. And what you've revealed to me by your vote is that most of you as investors would be willing to give up some wealth. In fact, you give up half your wealth in return for a good investment opportunity set. Since you can't control it or forecast it, what it means is that in your rational behavior, you would hedge it or try to. You'd be willing to give up some wealth in states of the world where the investment opportunity is good in return for having more wealth when it's bad, because you need more wealth when times are bad. That's at least what you seem to be revealing to me. Now, if you want to change your vote, you can. Now, this is not about interest rates. I could have more complicatedly said to you, which would you rather have, $5 million in a Sharpe ratio like this, or $10 million in a Sharpe ratio like that? And as long as you're taking risk, some of you at least would take the higher Sharpe ratio with 5 for the same reason. So it's not about interest rates, it's about the whole investment opportunity set, which is changing, and it's as true, and it's always been true, and it always will be true. So what's the point here? There is another systematic risk, like market risk that you grew up on, the CAPM, market risk, you get compensated with a risk premium because it's a risk that nobody wants to take unless they get bribed, and it's a risk you can't diversify away. I've just identified another class of risk that's like that. Another class of risk is changes in the opportunity set. By doing that, I've identified something that can have a risk premium, a systematic risk premium, like the market premium, not based on information, not based on frictions, but just based on the fact that in the real world, we live for more than one period, and the investment opportunity set is uncertain and changing, and it matters. Okay? So therefore, changes in the opportunity set can be something that we're willing to hedge for. Old people like me who want stability of income, we would be willing to hold real gilts at a lower expected return than treasuries, short terms, in return for income stability. And you young people may not care, so you're the other side of the trade, like the hedge fund. But we've got to bribe you, okay? And so we have so many of us wanting that, we'll actually see a market equilibrium potentially at below the risk-free rate in terms of expectation. Not because it has a negative beta, it's countercyclical, but because my risk-free asset is different than hers. And I'm a lot of me, and I need a lot of that, so I want more than the market share. That means I'm going to hold different risky portfolio as it's usually measured, because bonds are thought to be risky when you measure them relative to value, right? Anybody doubt that long long-dated real gilts have quite a bit of price volatility, okay? So the point is, that asset looks like it's mispriced in my world, and it is exactly priced. And the reason it has to be priced there is so that we can get what we want from those of you who are willing to give it. Nothing different. It's equilibrium. So I wanted to, this is the fastest way I know to get through this. This is, there's a paper out there, it's been on for 40 years, so it's not a news, that I happen to have written, but others have done, Steve Ross, which talk about the intertemporal CAPM, which is multi-dimensions of risk. They come out of an equilibrium model with no frictions and no information differentials, okay? But I thought I'd resurrect it and talk to you about it so you can see it in common sense terms, that there are other risk premiums. Another one I'll just mention, I won't go into a long list. What's assumed in the CAPM? We can sell all assets and all of us should sell all our assets off and then buy the market portfolio, right? And then scale it with risk-free asset. What is the biggest asset on the planet, I think? Certainly one of the biggest. Human capital. You ever figured out what you're worth on the hook? It's both makes you feel good how much you're worth, makes it scary when you realize how much money you have to have saved for retirement when you no longer have your human capital. It's a big number. Can I trade my human capital? Can she trade it to me? Obviously, she has, well, I can't know for you because we haven't met before, but if you were normally of your age, you have more human capital than you have financial capital, which is a good statement about what you're worth. And at my stage, it's pretty optimistic for me to say I have more human capital and financial capital, not because my financial capital is big. So we have a different mix. Intuitively, what we want to both do is, trade. Why? Because if I hold human capital in this pocket and financial capital in this pocket, or real estate or any other capital, if I hold market proportions, I don't care what factor shares are. I don't care if labor gets 75 and 25, 65 and 35, because I own anything. It doesn't matter. It matters for allocation, but it doesn't matter for my investment. It's not a risk. But when I can't buy her human capital and she can't sell it, she's forced to have a mismatch. She now has factor risk. If labor gets hurt, you get hurt. If labor gets benefit or gains, I get hurt. So it's a risk that we can't shed by direct trade the way the CAPM would assume. So intuitively what I do, I'll try to shade my risky portfolio to get more exposure to labor-intensive stocks, which is to get a longer position in human capital. She should shade her portfolio in the other direction, more capital. She should have more labor-intensive stocks. I should have more capital-intensive stocks. Sorry. So I ought to buy ExxonMobil, and she ought to buy retail or whoever it is. Do you see why? Because she's going to try to balance, and I'm going to try to balance the mismatch of my human and physical capital to do it. I don't want to get any further. I'm just trying to give you some big elements. So this is not some, and you'll never get rid of these things. I mean, I don't think we're going to allow trading of human capital, either ethically or any other way, okay? So the point is, I'm trying to show you there are risks out there that are as fundamental and systematic as market risk. They have always been there. They exist in Japan. They exist in the UK. They exist in the United States. And they will be here. They were here 100 years ago. They'll be here 100 years from now. They are permanent as any risk can be, like the market risk premium. That doesn't mean the premium doesn't change, just like the market premium. But they are systematic risks. And therefore, I call that dimensional risk for the other dimensions of risk. There are more dimensions than simply end-of-period wealth, whether you measure it, I don't care, mean variance or anything else. So I call that dimensional risk. Now, is this different from the other two? Absolutely. Is it an alpha? For sure, because the CAPM will not hold, therefore it's an alpha, and whichever side has a risk premium, whichever it is, will create that premium. Okay? This is, by the way, when you go to trading it, this is the most scalable of risks, because these big things, human capital, interest rates, they're not small sectoral things, and they're permanently there. The premium may change, but they're permanently there, and we can see why they're there, and they're not information-based, so this is the most scalable. Okay? How much time do I have left?
20 minutes.
20 minutes, okay. We'll get there. We're going to get there fine. All right, so let me stop and summarize. I've identified 3 sources of alpha. I've also explained how different they are from execution of those alphas in terms of the markets, scalability, cost, etc. All right, so maybe you're going to be kind to me and say, oh, thank you very much, Professor. You've given us 3 sources. That's lovely. So what? Isn't alpha alpha? Well, I owe you that. You notice I haven't gotten through too many slides. There's a bunch of them here, by the way, which you may enjoy at your leisure if you choose to have them. They talk about what I just did. I'm going to jump ahead and then maybe back depending on time, because I feel by looking at you, and especially with lunch in front of you, okay, that you ought to have some payoff for why you care about sources. So I'm going to try to give you what I believe are some of the benefits you can get from understanding and identifying the sources of alpha. And the first one comes to something that you all do, either for internal investment managers or external selection of managers. You're looking for people who will provide you alpha. Now, everybody has past performance, right? Everybody understands here that past performance isn't a sufficient statistic for future alphas. Past alphas, we heard that this morning. By the way, we should all be really happy about that, right? Every time my students say, Professor, can you give me a formula for how to do this? And, and I say, you should be so happy I can't. That you have to learn something. Because if I could, I'll put it on a USB port so you can sell it for like TurboTax for $79.95, and no one will pay these 6-figure or more incomes to you for it. So it's lucky that there's more to it than just mechanically looking at past performance and evaluating it with some algorithm. Because if it were, many of you might not be here, and I'd probably be raising petunias or something in my spare time. Okay? The point is that to do evaluations, you spend a lot of effort beyond the past history, how long they've been in business, all the things, the mechanical stuff. Important, but not sufficient, not nearly sufficient. I would submit to you, if you understand what the source of the alpha of the manager you're evaluating, you can do a much better job of evaluating that manager and its likelihood of that manager in the future. So if you have a stock picker, an information trader, I don't know how to evaluate them. I confess there are a lot of things I don't know how to do. Some people think, Nobel Prize is like the Leonardo da Vinci, Renaissance man or woman. It's not. They're a very specialized thing. So I know a lot, I think, about that. But other things, not necessarily more than a more or less reasonably average person. So, I just want to say that on this thing that I don't know how to tell you all of what to do, but what I can tell you here is if you understand the source, you'll be able to do the evaluation better. So if it's a stock picker, I don't know how to do that, but you do because you have people at shop. What if they are a hedge fund and their systematic source of alpha is financial services, as I described to you? They're essentially an intermediary, but they intermediate through capital markets rather than face-to-face transactions. Would you evaluate them with the same skills that you would a stock picker? No. What would be really important? That they be financed very well. Low cost. If you're an intermediary, you cannot compete if you're a high-cost user. If your funding is not very good. You have large spreads, you pay up for things. For hedge fund I was in, one of our great advantages is we were the best financed entity on the planet. We got better terms than the banks gave to their own prop desks. That's a very helpful thing to have if you're in the intermediation business, if you have very, very good financing, okay? And so you would be looking at them and say, how can they compete against other intermediaries who are providing these services? If they have crummy financing, they're not going to be able to compete well, even if they're smart. They have a disadvantage. If they're regulated, they're going to be at a disadvantage, right? Because you saw, the best thing is if you're unregulated or is low rate, then you can be on every side, doesn't matter. You don't care about taxes or anything. As soon as you start caring about the thing, that limits the scope or raises the cost of delivering that service. That's the sort of thing I would be looking at for a hedge fund to figure out what they're going to do. What about competition? Hedge fund made a lot of money, let's say in the past. Not in the recent past, but in the past. What do you think that might do? Do you think that might bring some interested competition in? Well, maybe other hedge funds, but who else could be a competitor? Now that you understand what they do, we see a sovereign wealth fund could be a competitor. May not be, but could be. What if sovereign wealth fund said, hey, you know what? We've got reputation, we've got money, we don't have any regulations, we don't need liquidity. We look like we're a pretty good thing. Look at all this money the hedge funds are making. Now, whether they be successful at that or not is not the point. If you were evaluating hedge funds and you knew that sovereign wealth funds were moving into this space, you'd have to be out of your mind not to take account of that in terms of assessing future alphas versus past. Okay? Do you understand the spirit of this? If you know the source, you know what questions to be asking and what to be looking at. I'm trying to show you that. I'll show you an example in a minute. All right? And I could go on, but you get the point. So in selecting a manager, it can help you to figure out, one, whether they've been lucky, or two, why conditions may have changed such that they're not going to be able to perform, or maybe conditions are better, but you understand what they do. Now, if you interview a lot of hedge fund managers and said, are you a financial intermediary, intermediation? No, I'm just faster, quicker, smarter. Well, maybe, but you know, they don't have to know what they're doing, the reason they're doing it, to be good. Frogs probably don't know their role in the ecosystem of a pond. They'd just be frogs. Now, they might be better frogs if they know their role, and maybe hedge fund managers would be better if they knew their role in the financial system. They would better understand it. They don't need to know it. So don't go out and interview, are you a financial services hedge fund, or are you a stock picker hedge fund? That doesn't work very well. In fact, a lot of times they may not even know. So that part I just point out to you. Now, we're not done, though. Suppose you've now picked the 10 managers who you have stipulated in your shop have alphas for the future. So it's no longer being discussed. We have the 10 managers. What's the second thing you have to do? How do you scale the trade with them? How much do you allocate to each of the 10 and in total? Right? Alpha doesn't tell you that, does it? You need alpha to decide that, but alpha is not a sufficient statistic. What do you need to know? You have to know how those funds contribute to the risk of your overall portfolio, if you like your personal beta. What else do you have to know? The correlation across those 10 managers. If they're all independent, we know what? If we take 10 managers equal amounts, how's the risk scale? It's not 10 times bigger than 1. It's the square root of 10, or about 3 something. If, on the other hand, they're perfectly correlated, 10 managers are 10 times as risky. Big difference, right? Big difference in how you would scale them. So it's pretty important to know how correlated, if you like. I use the term correlated in a broad sense. Okay? Now, let me go back, just show you something on this. This is a chart of hedge fund. This comes from a paper of a former student colleague of mine. These are the 10 categories or so of hedge funds: convertible bond ARB, dedicated short, emerging markets, equity, event-driven, fixed income ARB, global, macro, all the usual Tremont listing of hedge funds, right? They're in different strategies and they're in different asset classes. So suppose I have 10 hedge fund managers, all of which I've decided have alphas. And one of them is in, fixed income, relative value, another one's long-short equities, the third one is so forth, emerging market. They're all in different asset classes, they have different strategies. So, and if you looked at their history, maybe they don't have that much correlation, so you feel good, but you even feel better because you say it makes sense to me. They're in different asset classes and they're in different strategies. They've got to be fairly diversifying. However, what do you have from the insight of understanding the source? If the source for hedge funds is financial services, then even though they're in different asset classes, even though they're in different strategies, they share in common one big factor. They are providing financial services. They're an intermediary. Would you like to be going long financial services and intermediaries in August of 2008? No, I don't think so. It's okay to if you know the risk. The point is, that could be a huge correlated factor among all 10 of them, even though they're not in the same asset class nor in the same strategy group. because they're all performing the same function within the space of alpha. And when things go bad for that function, all of them are going to get hit. But you will not necessarily see that in the data in the past unless you happen to have suffered through a 208 or something else. You've all heard the stories how, in a crisis, everyone has a beta of 1 and perfectly correlated. Well, that's not really true. But what is true, that a lot of correlations come out, are very pronounced in those stress situations. This picture up here, which you can't possibly read, so I'll just tell it to you. I still got a few minutes, is the following. And again, this is not, it's going to look like a factor. I'm going to show you a picture like a factor. But since we've been talking about factor investing, let's be clear. I am not recommending this as a factor. It's 16 years of data. That's a peanut for factors, in my view, okay? So this is to illustrate the point I'm making here. So you know how you have those usual disclaimers, don't pay any attention. Don't take what I'm going to show you as that there's a factor there that you can make money off or should trade it. Well, what my friend did, my colleague and student and friend did, is he happened to be in a custodian, a very large one, for about a year, where he could muck around in there. And he had access to about 3,000 corporate bonds to see them all and everything, which most people don't get to see. Corporate bonds don't trade that much. So he did a kind of, hey, let's do a Jean Common French, see if we have a strategy here. And we all know that for a classic class, corporate bonds are classically relatively illiquid. So he had an idea, split the 3,000 bonds into the most illiquid and the less illiquid. They were all investment grade, so it's not a credit play, okay? But just on, quote, liquidity, the usual measures. And he went long the less liquid and short the more liquid, standard kind of factor type of analysis. And he created I guess you could call it an illiquidity factor. But what I want you to see is it came in, corporate bonds was the only source. It was not just general liquidity, corporate bonds. He then looked from 1994, when the index started, Tremont Index, through 2010, and ran the alphas for these groups. Guess what? All but dedicated short came up with large and statistically significant alphas. That shouldn't shock you. The hedge fund industry grew dramatically from 1994. It wouldn't have had returns not been very good. So that's not a surprise, right? Everybody would not be shocked to hear their big alphas for all the hedge fund classes. Then he did is he reran it using this factor as an additional explanatory variable and then computed the revised alpha x this factor. This is standard. And what happened? Well, convertible bond ARB went from a 700 basis point alpha to a 300 basis points. Emerging markets went from 1,250 basis points to 500. Fixed income arbitrage went from 947 to 43. Every one of them, the alphas net of this factor dropped dramatically. Every one of them. Big. Okay? Now, this could be coincidence, but you find that they're, okay? And, in fact, while all the T-stats on the alphas, the raw alphas, were very significant, the revised alpha, most of them are insignificant. That doesn't mean they didn't have other alphas. It just is a way of saying from the data, this one factor drove a huge part, at least in this period. That's why I say it's not a real factor to invest in. Okay? Now, what's impressive, had you done a fund-to-fund hedge fund factor and ran a common factor there, you wouldn't be so surprised maybe. But this was done with corporate bonds in one strategy. Why would corporate bonds, long, short, cover so many of the alphas of so many different strategies and asset classes? I don't know. Maybe it's luck. That's why I say 16 years is not long. But at least this is consistent with the view that I've expressed to you, which I gave as a conceptual one that I believed in when I talked to our investors 20 years ago. This is not a new idea. I told them that's where I thought we would make our money, is from intermediation, not being faster, quicker, smarter. Yeah, we had some pretty smart people. We had some pretty good models. So does the rest of the world, okay? But we told them that this at least is consistent with the view that hedge funds are performing this kind of common service, which when you say it's illiquidity corporate bonds, that's kind of likely to be correlated with frictions and other kinds of intermediation services. That's a story. By the way, that's what the factor looks like. Make your STOXX roll, but this is not for you to invest in. Okay? So is everybody, so that's a way of trying to make it. Finally, if you were looking at the dimensional type alpha, that one is the longest one. That's where perhaps a lot of the factors are. Fromm and French, when they found their results, they did, my work gave a structural reason for these, the ones that thank you very much for your services. An explanation. It was investment opportunity uncertainties, human capital versus, those are structural reasons. But the real world, as you well know, I think it's fair to say, started with Fromm and French in the technical elements of this, where they essentially found, two elements, value and size, which seem when you put it in to square the circle and make the C, eliminate alpha. They both say in their paper that value and size cannot be a structural factor. Size for sure not. Because if it were structural, it means if we take two small firms and merge them, their cost of capital would go down and we would increase their value because their cash flows hadn't changed. We would have a money machine. So I don't need to prove that to you. So size and value are not structural the way beta on the market is. You change the beta of a firm, you do change its cost of capital. You change the size of a firm, you don't change its cost of it. So you can't use it for corporate finance. But like many things, as long as you're not acting on it, as long as you're just using it as a forecasting tool, it seems to have worked. And that's fine. But what Fromm and French wrote in their paper was they understood that, and they said their theoretical justification was, they mentioned my paper, they had to have somebody's paper to mention, that said there are structural things underneath that we haven't been able to measure, but these are surrogates that we have found. And so for the econometricians among you, they were instrumental variables for the real variable. And when you change an instrumental variable, you don't change the world. Beta is not an instrumental variable, it's an actual variable. Value and size and momentum, all these things are not structural, okay? And therefore, you can't do things like corporate finance with them. It doesn't matter for investing as long as you're not changing things, okay? So what I say to you is that in that area, there's there. Now, I wanted in this last 5 minutes, okay, I was going to do this one, but I think I may even want to go back to the other. This one was just my list. Since it's all empirical, not theoretical, all these factors. Someone asked me once, how would you, if someone says, I got a factor, how would I evaluate it? Well, I'm not the best one to do it, but if I was forced to do it, I was on a desert island and I was the only one who could do it. Here's my list, and this is not scientific. This is just how I would think about it. You bring me a factor. The first thing I'm going to ask, is there a priori reason that it should be there? Is there a structural reason? If there is, doesn't mean that's the reason, but it at least gives me some faith that there's a reason why it's there. Like I see a market risk premium and you tell me why it should be there, it makes me more comfortable. Secondly, it should be persistent. This is for dimensional alpha, not the others. It should be persistent, meaning it should have been there forever. So we should find it in 50 years of data, not 20. Because this is a risk that had been there like market risk forever. Therefore, there should be no natural reason why it would arise after 20 years or only in the last 20 years or 30. Where for example, financial service alpha, of course that can happen because institutions have changed. We used to have in 1920s in the United States, really up to the 1950s and 60s, you had all individuals as the dominant investors. What do you have today and since 1975? Institutions. Institutions don't invest like individuals. So if you're a behavioralist, if you believe that behavior is explaining those alphas, then you ought to see a break where one kind of alpha that was there for individuals dominated and then disappeared and was replaced maybe with some group dysfunction of decision-making. It shouldn't be uniform for the last 80 years because you've completely changed the institutional way in which stocks are traded and who makes the decisions. This dimension, the thing that you answered, it's been there always, so it should be persistent. So if it's not been there for at least 50 years, it's questionable if it's that. The next thing it should be is it should be pervasive. It should be true in every country, not just some. For the same reason. Continuous, that one I'll give you very quickly. Think of size. You all know the way with size factors measures, take the great big mega cap stocks, that's one portfolio, go short that. Then take the little tiny micro, smallest ones, the decile, and you go long that. And you get the two extremes giving you the maximum measure of the size premium. That's fine, but if it's really a factor, a size factor, then it should be that it's continuous. So if I look at mid caps, they should have more of a risk premium than large caps and less of a risk premium than small cap. If it's only the two extremes, it may be there, but I would guess it's not there because of that factor. I would guess that big stocks have special features protecting them from risks such as too big to fail, we don't let General Motors go down. And little stocks have the problem that they can't get a big enough investor base for good diversification. It's something like that, not because if you find, though, that it's really continuous, you know, so as you go up right through every factor, you see it kind of, it doesn't have to be linear, it could be nonlinear, but you find it sort of monotonic and systematic. That's at least evidence that it's actually a factor versus something else, okay? Then we have robustness, and that's, you know, if you use correlations to get this classes, you know that they're notoriously unstable, and so you know your fittings are going to be, but if you use just, you know, have 10 buckets, everything in the same bucket is the same. If it works for that, that's more robust, you feel there. And then the last one is, can it be implemented at, you know, if it costs me 150 basis points to earn a 50 basis points premium, that's not a good deal. And momentum may be that way. You can tell me better than I. But that doesn't mean you don't use it, but probably you're better off not having a standalone momentum, no disrespect, if that's true. I'm not saying it is. But you might use momentum in your trading strategies where you're going to have to trade anyway. So, because momentum in its strict form takes a lot of trading. Okay, so let me go back to the last, oops, there, final. So, number one, this sourcing can help you to identify future alphas, okay? If it's dimensional, then you want to look at those elements. Again, very different. Number two, how you scale the investment, which is the relative risk, identifying risks that are not so obvious. I don't mean as a substitute for asset class or style in addition to. The third one is really for the CIO, CEOs of your organization, or whoever makes the decision about the org chart. How you organize your teams. For example, we used to have passive, active. That was the cut. And then we had allocations within them. And then along came smart beta. And they scratched their head. They said, well, that's not really active, but it's surely not passive. We don't know where to put these people. So they had to create a new org chart when they put in smart beta. The problem is, it's smart beta the last few years. Next year, it might be dumb alpha, you know, a new strategy, okay? So what I would suggest is, if you think about organizing yourself along the sources, your teams, I think you'll find that's more robust, because as you start to look at new strategies are brought to you, if you understand the sources, you may be able to do it better. Secondly, the skill sets are different. To evaluate a stock picker takes one kind of skill of your team. To evaluate a financial intermediary is quite a different skill set. And to evaluate dimensional is still a third. So if your teams are broken that way, now real managers can be more than one. I can have a manager who is actually in all three or two. And one of the reasons you can help them is if you break them down by source, they may be making money in two sources and losing in a third. Maybe you should advise them, hey guys, you're not doing so, you're doing well overall, but you would take a drag out if maybe you thought about whether you still want to be in this. But to evaluate a real manager, you would bring the team from, if it was partly financial services and partly stock picking, you bring those two teams in to evaluate that manager instead of having them done along those lines. So in my last, oh, I ran over, sorry. All right, so bottom line, sources of alpha. I think I've shown you three sources that are distinct in the way they're sources and where you need for them, the way you trade them. You know, if they're not scalable, we're not going to solve the retirement system funding with hedge funds, for example, because it's not scalable enough. So we know that. And then I've tried to give you what I think are 3 bread and butter items that everyone does in management all the time, whether it's internal or external managers, which is these 3 items that I've described. And I hope that pays for lunch, or at least for your hour you spent here. Thank you very much.
Thank you.